Hi, everyone, and welcome to one of our Happy Memorial Library events. We are thrilled today to have with us a guest speaker, Mr. Chris Maggio Jr. from Credit Repair of Texas. And he's going to talk to you guys about very important information, financial wise, what you guys can do, some good ideas. He's just got a lot going on that he's going to share with you. So, welcome, Mr. Maggio. How are you today?
Oh, I'm doing fine. Thank you very much. I'm very glad to be here and to be able to help out with this presentation. I've got a lot of good information that's very general in nature. And so with that, let's get right into the presentation.
All righty.
I'm gonna go ahead and share my screen with you.
Yes.
Okay, once again, my name is Chris Maggio Jr. I am the president, CEO, and founder of Credit Repair of Texas. My company is a service-disabled, veteran-owned small business. I also own a couple other companies, and the purpose of this presentation is to give you a foundation to start building your financial objectives, start achieving those objectives, and also looking at credit. So the purpose of this presentation is to kind of have you look at now is the time to set and achieve your financial goals. The disclaimer I would like to put out is that the information that I'm providing is a very general overview of concepts. I want to be able to help you and work with you. I'm not recommending any of my products or services for you to buy. If you have any questions about anything, you can contact me at a later point in time, but this is not to sell you any services. This is just to provide you general financial and credit information as you prepare to graduate and start your careers. Once again, no investment advice is being provided, nor should this be considered an offer to solicit or sell any financial or credit services. Beware of the small expenses in life. A small leak will sink a great ship. And it was Benjamin Franklin who said that, and I'm using that quote and giving him credit for it. As you start your careers, it's important for you to look at where every single penny goes that you earn and ensure that you have a budget and you follow that budget or you adjust that budget based on your financial means, meaning the ability for you to pay certain bills. You want to make sure that you know where all your money is going so that way you can achieve financial independence later on in life. This is a brief overview of the presentation. The first thing I'd like you to look at is to determine your budget and manage your expenses. As you graduate from college, you're going to start working, you're going to incur costs that perhaps you never paid before if you were living with family at home, that now those expenses are going to be your expenses as you start out on your own. So it's important to write down everything that you have as an expense. Also look at the income that you're going to have and look at what you can afford to spend so that you don't live beyond your means. If you start to work at a company, there may be employee benefits that you're eligible for once you've been at that company for a certain period of time. And I'm going to touch on those benefits in a little bit. Not all graduates work for a company that has benefits. And if you're going to be in that situation, then you have your own types of benefits that you can purchase on your own if you're a small business owner or if you're self-employed. So I'm speaking to both categories, those who are working as employees at a company and those who are self-employed and you're starting and running your own business. Both provide you very good career choices. It depends on the direction that you want to go. Just ensure that you identify benefits that you may be eligible for and take advantage of those benefits throughout your career. I recommend that you allocate money each month towards your retirement program before you pay any other bills, except for, of course, the primary bills you have to pay, like your rent, your insurance, your immediate expenses. But before you go out and buy something that maybe you don't need, I would recommend that you set aside a little bit of money each month towards your future retirement. Now, I know you're not thinking about your future retirement. You're just graduating from school, or you've just graduated, or you're about to graduate. So I know you're not thinking about retirement. But the more money that you set aside in your younger years, the more you're going to have when you retire. And I'm going to touch on that again in a little bit. I would like you to look at establishing credit. Credit is important. You need to have credit in life. Credit can be used in several ways. When you identify what you want to buy in the way of a home or a townhouse or whatever you're going to purchase, you're going to need to have credit to qualify for a mortgage. Sometimes people need to borrow money to buy a car so they can get back and forth to work. It's always best to try to pay cash for as much as you can pay when you're purchasing an item, and only finance the difference if you need to finance it. And in the case of a home mortgage, if you're buying a home, it's important to have that mortgage because you may not have a lot of cash to pay for that home, but also you want to finance that home through the mortgage because it gives you a tax deduction on your federal taxes. And sometimes if you have to buy that car, you need that car in order to get back and forth to work. But you cannot write your car loan off anymore on your taxes unless it's used for your business. So good debt to have would be a mortgage because that's tax deductible when you file your taxes with the federal government. The car loan, while it is very important, is not at this time tax deductible unless you own a business and you can deduct it as a business expense. And you would need to speak with a tax professional to give you advice on the deductions for the car. But the bottom line is it's important to establish credit, and then you need to look at how you would improve your credit score. And that's something that we'll touch on in a little bit. You should develop your financial knowledge through professional resources. One of the best resources available is the library. When you go into the library, there are free books, free publications. There's periodicals such as newspapers and magazines that are available to you as a student. And also later on, there are other libraries away from the campus that you should consider going to. And then you can always go to Barnes and Noble or other bookstores and read and purchase books or magazines within the financial field. I would like you to develop your financial knowledge so that way you can work towards what perhaps would be your ultimate goal, is to become a millionaire. And there's a lot of good information that's available to you for free to be able to help you down that path of setting and achieving your financial goals. One of the most important things is determine your budget and manage your expenses. As a new graduate entering the workforce on a full-time basis or a part-time basis, if you're going to be working part-time while you go on to do postgraduate work, maybe get your master's and still work part-time, you need to understand what your budget will be, and you need to stick to that budget. If you don't stay within the guidelines of your budget, that's understandable, but you have to find out why you can't stick to the budget. Is it because your budget is unrealistic? Then you should go back and look at all of your expenses, look at your income, and maybe tweak or refine your budget to ensure that your budget is realistic. But if you consistently miss your budget, then you may have a problem. And I'm not saying that you're spending more than is necessary. That's not it. What I'm saying is that you have to determine your budget and you need to manage your expenses to your budget. Next thing you want to do is document every single penny that you spend. Now, I know it's kind of unrealistic. You think, oh, I'm not going to write down everything. But sometimes, as I said before in one of my first slides, that leaking ship, that's the money that you're spending that you're not keeping track of. So ensure that you keep track of all of your expenses and put it either on a simple little tablet, or you can put it in an Excel spreadsheet, or if you, as you grow your budgetary needs, you could use QuickBooks or Quicken or other software, but you don't really need that now. Just write everything down so that way you know what you're earning, what you're using to pay your debts, and what money you have that you can invest. I always review my financial status more so than a monthly basis. I do it on maybe a daily or a weekly basis. Now, I'm in a different situation than all of you are, because I graduated and I served as an officer in the Army, and then I got out and I went into the business world. So I have to keep an accurate measure of financial status because I have employees who I pay. So I have payroll, I have responsibilities. There are families of those employees that it's very important for me to know exactly what money I have coming in, so that way I can pay my employees because they need their money to be able to provide for their families. So the moral of this statement here is take time monthly to review your financial status to understand what money you have, what expenses you have, and what you need to do to make sure that you're on track. And then, of course, adjust your expenses so you do not incur unnecessary debt. If there's any unnecessary debt, it may be a one time or a couple times that happens, but try to get back on track, because the only person you're cheating is yourself in your later years when you don't have the money that you want to have for retirement because it was perhaps spent unnecessarily in your earlier years. Do not rely on credit cards to pay your monthly expenses unless you're paying the bill off each month. So there's a pro and a con to that. The pro is, meaning the benefit of using the credit card, is that you have all of your expenses on that one card. And you know what comes from that is a statement. So you really have your whole expenditure right there. Because if you use your credit card for everything, paying for gas, for your car, for your grocery purchases, for your utility bills, some apartment complexes allow you to pay your rent on a credit card and you accumulate points. That's all good, because then you know where all your money is going because you always use that credit card or a debit card. Just make sure that if it is a credit card, that you're paying off the balance at the end of that billing cycle so you don't accrue interest. Sometimes credit card companies charge 15, 20, 25%, 30% interest, which is terrible, but that's how they make their money. So therefore, you want to make sure that if you're carrying a balance, you do everything possible to pay that balance off as quickly as possible so you don't accrue interest on the open balance. What you want to do when you go to a company that offers employee benefits is you want to identify all of the benefits that you may be entitled to as an employee. Normally, when you're hired for a new job, and you're hired as a full-time employee, you have to go through a probationary period at that company, which may be 30 days, 60 days, 90 days, whatever that probationary period is that's when you're looking at them to make sure that's where you want to work. And they're looking at you, the employer, to make sure that they want you there the rest of your career. Once you go through that initial period at the company, then you may be eligible to participate in the benefits. And once you're eligible to participate in the benefits, then a representative from the Human Resource Department, or perhaps your boss, whoever hired you, will be able to review all the program options that are available to you as a participant in the employee benefit program as a full-time employee. Depending on the type of employer who you work for, there would be different types of savings programs. If you work for a regular corporation, frequently that regular company, and I'm just giving you an example, say it were Apple or Google or Facebook, and I'm not recommending any of those companies, that's just a regular corporation. Frequently, they would have a 401k plan. 401k plan is synonymous with a company like one of those, of which there are hundreds of thousands of them, where you put the money in and they will match up to a certain dollar amount. So let's pretend that you work at this employer and you're now eligible for the 401k plan. And if you put 5% of your pay each month into the 401k, they will match it with 5%. And this is just an example. Every company is a different percent. So that's a 401k at a regular company. You want to put in as much money as the employer will match. Now, let's say that you work at a college or a university or a school system, elementary, middle, high school. You may have, not all have them, but you may have a 403B plan. That plan is more common for educators and those who are working at institutions of higher learning. Same concept. You may have a 403B plan similar to the 401k where you put a certain amount of money in and the employer would match it, or maybe the employer automatically allocates money whether you match it or not. They're going to put in certain things. It depends on how it's done with that school district or that university or that state. And then lastly, and there are other programs, these are just three major ones, but there is a 457 plan. And the 457 plan is normally synonymous with somebody who works in law enforcement or other types of law enforcement related employers, such as, say, sheriff's department, police department, federal service, things of that nature. That's their version of a 401k plan, and that would be the same thing. If you worked in one of those fields, you may have that same type of plan where you put in a certain amount of money and they'll match that. And then as you stay so many years, they may even bonus you additional money. And that's to encourage you to continue staying with that organization throughout your career. You want to understand your employer matching investment options. So let's say you worked for me, and this is just an example, and you're a full-time employee. My company, as an example, we would give you $10,000 for every $10,000 you invested in the plan. So when you're putting that money in the plan, you're not supposed to touch that until you retire and you're in your 60s. But let's say you're putting in 10,000 and we're putting in 10,000, that's $20,000 a month for X amount of years. Then when you go to retire, you can take that money with you and you can transfer it out of a 401k into your own Roth IRA, or that's a retirement account or other type of investment. So that would be your money to take. But if you touch that money, meaning if you withdraw it before the federal retirement age, then you may have to pay a penalty to the federal government, because these funds are your retirement funds and they're designed for you to leave them in there until such time as retirement comes. So if you were to pull that money out early and go out and buy a brand new Mercedes, then you may be charged two penalties. The first penalty is a penalty for early withdrawal. So let's say you're charged 10% penalty for the amount of money that you took out because you took it out before age 62, as an example. But then you'll be charged a second penalty. It's not really a penalty, but the money that you take out is now going to be counted as income for that year. So say you would normally earn 60, 70, 80,000 a year, but you took money out of your 401k. So now you took 40,000 out. So you're going to have to pay $4,000 penalty because you took it out early, but you also have to count that 40,000 with the 80,000 that you earned this year. So next year you're going to have to pay income tax based on, say, $120,000 in income because you took that other money out. Unless you incurred a financial hardship, then sometimes the Internal Revenue Service has special programs to help you through that. You should also learn about health insurance, life insurance, disability insurance, and long-term care options. Now, I don't have time to go through all of these today, but what I would like you to do if you're going to work at an employer, meaning at a company, is sit down with the human resource representative, as I've indicated in my second bullet up here. Find out what you're entitled to and then determine what you feel are the most appropriate benefits, because sometimes you're only allowed to enroll when you become eligible, or you're eligible maybe a year later when they have what's called open enrollment, you may be able to add those benefits. So speak with the human resources representative to ensure that you know what your entitlements are, and ask questions. You want to allocate money each month towards your retirement program. Make sure that you're putting that money in, but only put in up to what they will match. So back to my example, say that you're going to put in 5% because the employer will match you for 5%. Don't put 6 or 7% in. Use that other 2%, and you may want to look at outside real estate investments, or you may want to look at mutual funds, or annuities or stocks or bonds or other types of investments that you can do on your own through a reputable financial advisor who can give you advice on setting up an account. There's different mutual fund companies. There's thousands of mutual fund companies that are out there. You can set up a small mutual fund for maybe $100 a month. You can have that money go right into a mutual fund. That mutual fund invests your money along with my money and Cindy's money and everybody else's. They bring in $100 million, and they turn around and take that $100 million. And depending on what type of mutual fund company it is it a stock fund? Is it a bond fund? Is it a commodities fund? The mutual fund company invests that money. If it's in a stock fund, they buy Apple stock and Google stock and other types of stock. And then you are paid dividends based on how many shares you own in that mutual fund. So it's a great way for you to start buying stocks without buying them through a stock broker where you're paying a large commission. You could buy it through a stock mutual fund where you're still paying a little bit of commission, but it's a very small percent. So say you invested $100 a month, maybe about $96 a month would go into the stock, and the other $3 goes to the mutual fund company and the representative and the overhead. So look at different ways to diversify your investments in addition to participating in your employer plan. You should look at establishing credit, because credit is important not only to have good credit, which affects your ability to be hired by your employer as they do a background check, but also having good credit enables you to have better, meaning lower interest on your home loans, that would be your mortgages, your auto loans, and on your credit cards and insurance premiums. So it's important, as you start with a credit card, you want to get a credit card that's going to help you not only pay your monthly expenses, but also be able to establish your credit. Now, what types of credit cards do I recommend? I recommend a credit card that you can use to pay different bills. Now, I'm going to give you an example, and there's nothing against this company, but I'm going to give you an example of the credit card that I don't recommend to help you with what I want you to do. And that would be a credit card at Dillard's or Macy's or certain other stores where you can only use their credit card to buy products at that store. Those companies are very good and their credit cards are good. But the type of credit card I think you should have, if you're going to get one, is a credit card that would be a Visa, a MasterCard, a Discover, or American Express that you can use to pay the bills. You can't pay your grocery bills or your gas bills for your vehicle or any other expenses using that Macy's card or that Dillard's card. That's only for their products. So when you establish credit, you want to have a card that you can use to pay your monthly living expenses. Still get those other credit cards too if you feel that you really need it, but you want one or two or three cards that will help you with all of your expenses and also allow you to build up your credit score. Most states allow credit-based insurance scoring, and that means that your insurance company is allowed to pull your credit to see if you're going to be a high risk driver or a low risk driver. Now, what does your credit score have to do with how good your driving is? Actually, it has a lot to do with that, because if when they look at your credit report, they find that you're not paying your bills, sometimes you're 2 or 3 months late paying your credit card bills, that means you're a person who is a little riskier in the eyes of that insurance company versus somebody who pays their bills all the time and is very punctual, may be a less risk of having an accident, or maybe driving too fast or things of that nature. So your credit score is very important because it also affects your insurance. It also affects other things, but also the information on your credit report is looked at by your employer as they do background checks to determine if they want to hire you. Now, why do they do that? Sometimes your job at your employer may require you to have a credit card. So you may have to have a credit card in order to work at that company, because the nature of the work that you're doing may require you to travel for business. Well, you need to have a credit card in order to pay your hotel expenses and your travel expenses. And then when you get back to the company, then you do your travel voucher. And not always does the company give you their own credit card. They expect you to have credit, and you have a good sized credit line to be able to afford to pay the travel expenses. And then you submit your voucher and then they reimburse you. So your credit does affect the relationship with your employer. A variety of other factors go into evaluating your rates, and insurance companies don't rely. So insurance companies assess your risk based on how well you handle your money. The reason why they allow these companies to do this scoring model is they feel that if you handle your money properly in their eyes, meaning you pay your bills on time, then you would be a lower risk insurance client to them. And therefore, they don't think you would have perhaps as many accidents or claims or issues, because you're very, very focused on paying your bills in a timely manner. And you're also ensuring that you do not do things that perhaps could cause a risk to the insurance company in the form of claims. So it's important that your credit score is as best as it can be, and your credit history reflects not only a solid payment history of paying your bills on time, but also ensuring that as either an insurance company or a mortgage company or as an employer looks to hire you, that you have the best report card as possible on your credit score, which is a representation of some of the things in your background. A variety of other factors go into evaluating insurance rates, and the insurance companies don't necessarily have to use your credit score for the entire process. The reason why I included this is because maybe you have problems with your credit score and the score may not be as good as you'd like it to be. I don't want you to worry about that score right now. If those problems are there, just work to try to improve those problems, maybe by disputing any information that's not correct or accurate. Uh, Contact the creditor, say maybe you were late in paying a bill, contact them, explain the circumstances, and say perhaps because of the COVID pandemic or because of other factors that occurred that maybe you weren't working at the time, you were late in paying certain bills, but you'd like to try to work out a payment arrangement. So that way you can address those bills, pay the bills, which could perhaps improve your credit or at least explain the backstory behind that. And that way the insurance companies and the creditors understand those circumstances, and they'll try to work with you to come up with a favorable solution. And just remember, so much can be learned about you by just reviewing your credit. You're going to want to make sure that the next time that somebody looks at your credit, that they see you as a great person to hire, as a potential employee coming right out of college as a new graduate, or they want to make sure that you're a good person to do business with. If they want you to become a client of theirs, they know that your spending habits and your personal history in the credit and in your financial picture are such that you would be a good hire for that company. You would represent the company properly when dealing with their clients, and also that you would do well on the credit side of your life. Learn how to improve your credit score. You first have to understand what a perfect credit profile may look like. You may hear people say they have an excellent score. An excellent score is 850 points. That's the top score in the tier. Not everybody has 850 as their credit score. A lot of people have scores that are perhaps in the low 800s or the 700s or the 600s or even lower 500s and maybe a 400. Those lower scores are not good to have, but each person has certain circumstances behind their score. So if your score is low, do everything that you can to improve that score to get it as high as possible. If you have derogatory or negative information in the credit report, look at your Experian, Equifax, TransUnion credit reports to try to clean up or remove or write a letter to explain the mitigating circumstances to try to get those scores improved. One of the things that's so important to have in a credit history is the length or the age of your credit file. Now, just graduating from college and starting your career may mean that you're not going to have credit. And since you don't have credit established, you have what's called a very young or a thin file. And that means there's not a lot of history. I've had credit for many, many, many years, so my file is very comprehensive. I've bought homes through the years. I've bought vehicles, leased vehicles. I've invested. I've got all sorts of things. So my file has more credit information and it has many years of history versus maybe your file that you're just starting out with. So even if you have very good credit, but you don't have much credit, don't worry, because in time you'll be able to add to your credit history as you buy a home or buy a vehicle or lease a vehicle or consumer products. In time, it will all work towards improving your overall score. At the very minimum, at some point in time, you should have about 5 revolving lines of credit. It could be a car loan and maybe a couple credit cards, or it could be maybe student loan and your car loan and other things, but 4 or 5 lines or trade lines on your credit bureaus, which should appear on all 3 bureaus, Experian, Equifax, and TransUnion. That will help to build your history. If you only have one trade line, one credit card, and you don't have anything else, that's okay because you're being very conservative. But at the same time, you may want to open a second, third, fourth over the next couple years. You don't have to use them all the time. You could use one credit card just to get a tank of gas for your car, pay it every month. You can use the other ones, just have a small charge be placed on each one of those cards each month, but always pay it off. And when you're not using a credit card, don't close the account. It's best to have several lines of credit and have them open with no balance than to have a credit card and say, oh, I'm not going to use it anymore. I don't need it. And you close it. Then that's one less trade line. So it's best to have the cards, have them open, have them for many years. And then if you use them every once in a while, that will help boost your score. But closing them is not necessarily going to help you. Speaking of cards, look closely at the credit cards. I don't want you to pay an annual fee for somebody to give you credit. So if you're looking to open a Visa, MasterCard, American Express, Discover card, make sure you're not paying 30, 40, 50, $60 a year just for an annual fee for the privilege of charging things on that card. Go find a card that doesn't charge you a fee. There are credit unions that offer credit cards that don't have an annual fee. There are banks, there are other types of programs that can help you. I don't want you to pay an annual fee for the privilege of charging something on your card. Uh, the balance should ideally be under 10% of your total credit limit. Now, I understand if you have a large credit limit, that means how much you can charge on the card. But if you're going to have a balance, try to have it be 10%. You know, sometimes it may be 20, 30%, but pay that bill off as quickly as you can. But say you have a $5,000 or $10,000 line of credit. Don't use up all your line of credit. Don't charge it up to $4,900 because first of all, I want you to pay it off as quickly as possible and not accrue interest. But secondly, you don't want to use up all of your available credit because that will hurt your credit score. So having too much debt on your credit cards and not paying them off quickly can adversely affect your score. And also, don't go out and frequently apply for new cards, because every time you apply for a credit card or apply for a loan, if you don't need it, don't apply for it. Every time you submit an application, that's called an hard inquiry on your three credit bureau reports, Experian, Equifax, TransUnion. Now you have what's called a soft pull and a hard inquiry. Soft pull means the merchant is just taking a look, but they're not gathering all your credit information. So a soft pull does not necessarily hurt your credit score. But having a hard inquiry, like going to a car dealership and looking at four different cars at four different dealerships and doing a car loan over a period of several different days, may be treated as four different loan applications and could adversely affect your credit score. So be careful, know exactly what you want to buy, and at that time do that application for that loan. If it's for a vehicle or if it's for a mortgage for a home, do that, get approved, buy it, and then pay it off as quickly as you can if it's a car loan or a credit card. As I said before, the home mortgage is good to have because yes, you're paying interest, but that is still tax deductible on your federal income tax. You need to look at developing your financial knowledge through professional resources. Something I've always done through the years is read different publications. Turn to the library for a lot of excellent resources. You have magazines, you have newspapers, you have books, you have online resources. There's a lot of good programs and services that are out there that are beneficial to you, and most of them do not cost any money. I recommend starting at the library. Speak with the librarian, say, I want to develop my financial knowledge in these areas. What are some of the things that I could take advantage of that are available here for free? If you can, and I'm not recommending that you have to get this, but if you can, if you could pick up the Wall Street Journal or Bloomberg or some of the different Financial Times or different newspapers, read them for free. Even if they're a week old and they're outdated, if you have them in the library, read them because you're going to learn about ETFs, which are exchange traded funds. You're going to learn about mutual funds, annuities, stocks, bonds. You're going to learn about real estate. All of these things are good for you. A magazine that I like, and I'm not recommending that you buy it, I'm just saying it's a good magazine, is Money Magazine. If you read Money Magazine, it's a monthly publication, and in Money, they have monthly scenarios. They say if you had $10,000 available now, these are different options for how you could invest it. So Money focuses on you as an individual. Forbes magazine is more corporate finance. Some of the other Inc. magazine I highly recommend if you're thinking about becoming an entrepreneur. That magazine is written with you in mind because they help you look at businesses to start, look at businesses to run, look at businesses that failed. And they give you examples or case studies on why this business failed. So that way you could learn about that to help you with your own business experience in the future. I would also recommend that you, if possible, pursue additional education at the graduate level so that way you can build on your financial astuteness. It's important to be able to get that solid foundation, regardless if you want to go into the medical field, the dental field, management, whatever you want to do, having solid business knowledge will help you set and achieve your financial goals. And then I would recommend that you seek financial and credit advice from professionals in the field that you want to learn about. So you may want to learn more about financial planning. Sometimes I'll speak with my clients, I'll look at the client's age, and we say, you want to be a millionaire by this age. This is exactly how much money you need to set aside a month for the next 20 years, 30 years, 40 years. And I create a blueprint or a roadmap to help them get from where they are now, leaving college, if they want to have 5 million, $10 million by this age, these are some of the things that they should look at. That's an example of seeking that financial and credit advice from people who are in those fields, and certainly ask for help. If there's certain things you want to do and you can't achieve your financial goals yourself because you don't know where to begin, reach out, speak with a librarian, speak with financial professionals, and they can help you get resources for free to help you move in the next direction. So what I would like to do now is summarize before we go into any questions that may come up. This presentation has been just a very general overview of some of the financial concepts and credit concepts to help you identify and achieve your financial and credit goals as a new graduate. You are going to work your whole life. You can either be poor or you can be a millionaire. The choice is yours. You can do whatever you want to do with your career, and you can be very, very successful. If you want to be a millionaire, you need to start thinking and looking in the direction that you want to go to achieve those financial goals. And there are people out there who can help you. During this presentation, I have not provided any specific investment advice, nor do I want to sell you any product or service. I just want to give you a general overview of where you are now, where you're going, some of the benefits that are out there that are available to you, and be able to help you with any questions that you may have. If you have any questions, or if you want free advice or mentorship about anything that I've covered, or if you just need general advice, or if you're in a group or an organization and you would like me to come in and speak for free, please call me on my cell number, Chris Maggio Jr., 512-331-0222. You can also text me. Okay? So I think that pretty much covers everything. I hope that it's been broad-based enough to touch on different subjects. Sorry that we had a couple technical difficulties along the way, but I hope it all makes sense.
It was great. And if you will, hit the stop share button because I have some questions. Guys, this is a pre-recorded um, video that we've done because our speaker is very busy a lot of times and he doesn't know where he's going to be. But what we suggest is if you do have questions, either email him or you can go ahead and put your questions in the comments once this video is posted, and we will get your questions on over to him. But I have a couple of questions.
Okay.
I recently, Experian has been doing this Experian Boost thing where you can add your rent, you can add your streaming services, you can add everything. Now, it raises Experian's credit line score. However, the other uh, credit companies are like, well, you have too many things open now. So, what do you suggest? Like you said, five, the minimum. What would you say would be like the maximum to add to your credit reporting?
It depends on what the individual does. If the individual is a small business owner, then they may have multiple credit cards and lines of credit and other things that are out there. So some people have, and then they may have accounts that are very, very old that they don't use at all, but they're still open. So each client or each individual is different. However, the Experian Boost, and Equifax is coming out with a similar product, and TransUnion has one, is good because it does report all of your expenditures. So if you're renting, it reports your rent to the bureaus. It reports everything that you spend from your checking account or a credit card is good as long as you're paying the bills in a timely manner. We have clients who use Smart Credit and Experian Boost and others who are not punctual when they're paying their bills, and it actually hurts their score. So I do recommend that On the high side, you may have as many trade lines as possible, uh, as long as you're not overdoing the amount that you're charging, therefore tying up your whole credit line, and you're paying your bills in a timely manner, you're going to be okay. And I do recommend the boosting platforms, which are free, as long as you're paying everything on time.
Right. And another question, I know several people who they ended up getting a divorce and they didn't realize that the credit scores were connected. And one partner or past partner was not paying bills, one was. How does somebody, if they do get a divorce, check to make sure their history is completely separated from the other person's history? And how long does that affect the scores?
Very good questions. First of all, it's sad when somebody gets a divorce, but when they do decide they're going to go through the process, it's important for the attorneys to have a list of all of the debts that each one of the spouses has. And they have to agree as part of the divorce decree who's going to keep what debt and who's going to pay for it. And then in the divorce decree, it should say, and I'm pretending, there's these 20 debts, and 10 debts will belong to this ex-spouse. They will be required to pay them, and these other debts will be, to the other ex-spouse. And so in the divorce decree, a copy of the decree should go to the creditors to say that by virtue of the order of the judge and the court in the decree, this is no longer my debt. Frequently what happens is that's never done properly. So then one spouse, out of perhaps spite, or maybe they don't have the financial means to pay, doesn't pay any of those debts. If it was a joint credit account, both spouses or both ex-spouses are responsible for repayment of the debt. Another problem I frequently see is clients who go through the divorce never refinance the home to take the other spouse off the deed and off the mortgage. Now, if the couple bought a house together and both names were on the deed, but the house now is going to one spouse as part of the divorce decree, that spouse needs to refinance that house to get the other ex-spouse off, unless the divorce decree enables the mortgage company to go ahead and take the ex-spouse off, at which time it still has to be amended with the clerk of courts in the county where the decree is and where the mortgage is filed to get the ex-spouse off. But if the house has to be refinanced, sometimes the ex-spouse is not able to refinance it to cash out the other ex-spouse because they need both incomes together to refinance it. So then that results in the house having to be sold in order to pay the mortgage off. And there becomes issues that have to be addressed with the attorneys. Even if it's a nolo contendere simple divorce where somebody is agreeing to do the divorce on their own without using an attorney, the two ex-spouses say, okay, you're going to take this, I'm going to take that, let's agree to this, let's put it in writing, we'll stand in front of the judge and say, this is what we've agreed to. They still need to take that step to clear up the paperwork on who's the custodian of what accounts, or the creditors have the legal right to come back and demand from both of them. And in the case of the mortgage company will foreclose if the payments are not made.
Okay, a lot to think about. Um, it, this is something that everyone, when they're just starting out, they're not thinking about saving for their retirement. They're not thinking about how to build credit. So you have given a lot of great information that our students can go ahead and start thinking about, and I really appreciate that. And if anyone has questions, put it in the comments and we will go ahead and get them answered. Not at the exact moment because this isn't a live stream, but we will get it done. So thank you so much for joining us today, sir. We really appreciate you taking the time. And yes, we did have some technical difficulties. So this has been an adventure, but Did you have any closing comments or
I
anything?
I'm just very proud of all of you as you graduate and start your careers. And remember that your financial destiny is in your own hands. If you ever have any questions, you know how to reach me. I also occasionally do a radio show where I participate in the radio programming at KNCTFM 91.3. That's your station on campus. So sometimes you may hear me there and you say, oh, I know him. But at any rate, I'm here to help you in whatever way I can. And thank you, Cindy, for everything you've done. And good luck to all of you as you start your careers.
Thank you. Thank you. And before we go, guys, I want to give y'all some reminders about our upcoming events. On November 1st, we have Cynthia Goodwin of Great Western Dining. She is going to be doing a demonstration on Native American cooking for our Native American Heritage Month. We also have on November 8th, we're going to be showing pre-recorded veteran stories. We did this in the spring and we had an amazing group of people who told their story. And so we are doing some more pre-records and we will be showing them on November 8th. That one will be starting at 11 a.m. The Native American will be starting at 12. And then on November 15th, we have our CTC astronomer Warren Hart doing our virtual night sky tour, and he'll be doing it for the month of December. December is always an amazing time to look up during the at nighttime because not only are there beautiful stars, but that's when those meteor showers come in real heavy. So thank you so much, everyone. And you guys have an awesome week, and we'll see you next time. Thank you.
Goodbye, everyone. Take care. Thank you. Bye bye.